The national portion of the life insurance exam requires a precise understanding of the accumulation phase versus the annuitization phase within an annuity contract. These two stages represent the life cycle of the product, and testing usually centers on when the money is accessible and how it is taxed. During the accumulation phase, also known as the pay-in period, the contract owner is making premium payments or allowing a single lump sum to grow. This is the stage where the insurance company credits interest, and that interest grows on a tax-deferred basis. It is vital to remember for exam questions that the owner maintains full control during accumulation. They can surrender the policy for its cash value, take partial withdrawals, or change the beneficiary at any time. If the owner takes a withdrawal during this phase, the Internal Revenue Service views it through the lens of last in, first out taxation. This means the first dollars taken out are considered the taxable interest earnings, and the last dollars are the tax-free return of principal. Many students miss questions regarding the death benefit during this phase. If the annuitant dies while the contract is still in the accumulation phase, the beneficiary receives either the total premiums paid or the current cash value, whichever is higher. The transition to the annuitization phase, or the payout period, is the most critical junction for an annuity. This is the moment the owner chooses to convert the accumulated value into a stream of periodic income payments. On the exam, you must recognize that this is generally an irrevocable decision. Once the contract enters the annuitization phase, the owner no longer has access to a lump sum cash value, and the policy can no longer be surrendered. The insurance company takes ownership of the funds in exchange for the promise to pay a certain amount for life or a specified period. This is a common trap on the exam, where a question might ask if an owner can withdraw $50,000 for a medical emergency after they have started receiving monthly annuity checks. The answer is almost always no, because the cash value has been liquidated to create the income stream. When you look at the tax treatment of the annuitization phase, it shifts from the last-in, first-out method to the exclusion ratio. This formula determines what portion of each payment is a non-taxable return of the original principal, and what portion is taxable interest. A helpful way to keep these two phases straight is to use the mental shortcut of the sponge and the squeeze, where accumulation is the stage where the sponge is soaking up water, and annuitization is the stage where the sponge is squeezed to provide a steady drip of income that cannot be put back. Questions will often try to trick you by mixing the characteristics of these two phases. For instance, A might suggest that a contract earns interest during the annuitization phase in the same way it does during accumulation. While the underlying assets might still be invested, the exam focuses on the fact that the phase is now about distribution rather than growth. You should also be prepared to identify that the insurance company calculates the payout amount based on the annuitant's age, gender, and the payout option selected, such as life-only or joint and survivor. Remember that the accumulation phase is about building a future resource, while the annuitization phase is about liquidating that resource for a current income guarantee. If you see a question asking about the surrender of a contract, check immediately to see if the scenario says the contract has already been annuitized. If it has, the option to surrender is gone. Focusing on this point of no return will help you avoid the most common pitfalls on the National Life Insurance exam.